Okay. So we are ready to move into chapter 10. Get this going.
You threw out the partial?
Yes, because I think the fact that it said depreciable cost, it gave the depreciable cost and the initial cost, it tended to throw people off, and a lot of people used initial cost instead of that depreciable cost to calculate it. So I didn't think it was like the actual partial part that threw people off from looking at it. It was the cost versus the depreciable cost. So I went ahead. I really just went in. Thankfully, in Cengage, they have this nice little analytics tool where I can go in and see, like, out of everybody in the class, how many got it incorrect or correct. And so I just chose some of the ones that were below 50% correct as far as class-wide. So that's why some of them were like, oh, that one I got right. But class-wide, it was not one that everyone got.
What were some of the ones that people got wrong?
Let's see, I think I threw out. Okay, so chapter 10, we are switching gears. You know, in chapters 8 and 9, we talked about assets, current assets, and then long-term assets. So 10 and 11 are liabilities. So in chapter 10, we're going to deal with short-term or current liabilities. And then in chapter 11, we are going to deal with long-term liabilities. Okay, and I think we'll kind of do the same flow that we did in chapter 8, where we'll talk about a concept and then do an example together. Okay, so we'll be opening up the chapter 10 practice here in a little bit and kind of working on as we go. There's really, as far as the main concepts in chapter 10, just to kind of give you an idea, we're going to deal with notes payable. You know, in chapter 8, we dealt with notes receivable, so that was money due to us. Now we're going to deal with when we owe, so it's a notes payable. So notes payable can be either a current liability or a long-term liability, depending on when we owe it. So if we owe it in the current year, if it's due within 1 year or the current year, then it's a short-term notes payable. And that's what we're going to deal with more in this chapter. And then if it's something we owe, you know, next year or 3 years from now or whenever, then it becomes a long-term notes payable. Okay, so it's really the same. The current versus long-term is pretty much the same determination as assets. If it's something that we owe in the current period or within 1 year, we consider it a current asset or liability. Okay, if it's something we owe beyond, then it's going to be a long-term liability. The only tricky thing is, like, some liabilities have both current and long-term aspects or attributes. Like, think of if you have a car payment. You may pay it monthly, right? But you may pay it for 5 years. So what you owe in this current year would be a current liability. So all the payments you're making this year are current. And then from years like 2 to 5 or however long you have that note, that's considered the long-term portion of that liability. And we won't get into accounting for that too much. It's just kind of good to understand, you know, that a liability can have current debt associated with it and still have a long-term aspect. So we're going to do notes. Then we're going to look at installment notes, which is like a car payment or a mortgage note or anything that you're making either monthly or yearly regular payments, you know, like a portion of the principal plus a portion of the interest. Yeah, so very, very much like a car payment or just a loan payment that you're making at regular intervals. So with installment notes, we'll look at these, but, you know, usually your payment amount is the same, but the amount going to principal and interest change over time. Okay, so we're going to look at those. Another short-term liability that we'll look at is like payroll liabilities. So, you know, we have to have employees to run our business. So establishing those payroll liabilities, so that'll be something we cover in this chapter. And then we'll talk briefly about contingencies, and I want you to understand them, but you won't actually have to account for them too much. It's really, I just want you to understand the function. We'll get to that in probably Tuesday, though. So today, I anticipate we'll get over notes payable, and I think it then goes into payroll. So we'll kind of look at that. We'll play it by ear. So again, we know what a liability is. A liability is just a debt that we owe. Okay, so that hasn't changed as far as the function of what a liability is. So, you know, when we establish some type of liability, in this case, we're the borrower or the debtor. So we're the ones who owe. So when we're talking about liabilities, we're always talking about from the perspective of the company, we owe somebody money. Okay, so we're the debtor or the borrower. And then the company or bank that we owe money to is the lender or the creditor. Okay, they're offering us credit. They're offering us a loan. And then again, I already mentioned this, current liabilities are debts that'll be paid out of current assets, or they're due within 1 year, and then long-term beyond a year.
Is that within one whole year or like the end of their fiscal?
It usually is within their fiscal year, but it could be, usually we look at it within the current year, so within this fiscal year, yeah. We would look at it at the beginning of the year and list current liabilities, anything due within 1 year of that date, yeah. So usually when we list current liabilities, it's at the end of the period, like on your balance sheet. So at that point, we would list any liabilities that are due within, you know, basically within 1 year. So we say 1 year, or it could be a fiscal year, it could be a calendar year. That's where it gets a little tricky, but we're really analyzing that at the end of the period. So it's usually 1 year from that, the end of the period. We've dealt with accounts payable before, so, you know, we're really not dealing with that in this chapter as much, except for maybe switching from an accounts payable to a notes payable like we did with accounts receivable, notes receivable. But we know, you know, accounts payable was when we just purchased on account. You know, we created a debt, we created a liability, but there was no interest attached to it, right? We just, you know, got invoiced or billed, and we paid it within 30 days or 60 days or 90 days or whatever. We also have what's called accrued liabilities. These go back to chapter 3. You know, those adjusting entries are very important. They always come back in financial, whether we like them to or not. Accrued liabilities are a liability that has accrued, or it has, you know, kind of been accumulated that we haven't paid yet, okay? So those were adjusting entries we did at the end of the year. I think the big one we did was like wages payable or salary payable. So that was when, you know, employees had actually earned pay. They had worked and earned pay, but we weren't paying them until the next period. And the best example of that is, say you're at the end of your fiscal year. Well, an end of a fiscal year could fall in the middle of a pay period. You know, we could be, if we pay our employees every week even, well, what if December 31st was on a Wednesday? Well, maybe Monday, Tuesday, Wednesday, that pay goes in this past year, right, the current year. And then Thursday, Friday's pay is actually in the new year, right, because January 1 starts on Thursday. So that's when we look into, okay, well, we may not pay them until the next Friday, whatever that would be, like the 7th or 9th or whatever, and 9th, just doing math in my head. But we need to recognize the salaries payable in the current year. So they worked the 29th, 30th, and 31st. That earned wages needs to go on that year, even though we're paying them next year. Okay, so that was one of those adjusting entries, just like we adjusted for interest and, you know, all that fun stuff. So that's an accrued liability. An accrued liability could also be on a note payable, like interest that we owe that we're not paying until next year. We did that with notes receivable, remember, like, but it was interest revenue. It was revenue that was due to us, an accrued revenue. This is really the same concept. We're just looking at it from a liability standpoint. We owe it now, okay? So accrued liabilities are usually payroll and interest. So it'll be an interest payable, though, interest that we owe instead of money owed to us, okay? And it just tells you, you know, for most companies, accounts payable and accrued liabilities are the largest portion of their current liabilities. However, instead of having just accounts payable, we could have a note. So notes may be issued to creditors to satisfy an accounts payable that we've already created. Again, this is the same concept as notes receivable, but now we're the one who owes. So maybe we don't have the funds to pay off one of our creditors in accounts payable. So we call them up and say, hey, we need 30 more days or 60 more days, and we want to convert that accounts payable to a notes payable. So that can happen. And as you can imagine, it looks like this. So Nature Sunshine Company issued a 90-day 12% note for $1,000 dated August 1st to Murray Company for a $1,000 overdue account. Well, in that case, we're, again, just switching from accounts payable to notes payable. So we debit the accounts payable to Murray Company to clear that out, and we credit notes payable just for that principal or face value of $1,000. Okay? So we're just issuing a 90-day 12% note to replace the accounts payable. So Murray Company is giving us 90 extra days to pay. But in this case now we have to pay interest. Okay?
Yeah.
I don't have a slide. Oh, you know what? I think you guys, I have like 2 PowerPoints out there. Bless you. Under Unit 2, if you open the student PowerPoint, it's not as long. But if you scroll down, you should see just the chapter 10. It's kind of below, down at the bottom. Sorry about that. I think I realized like mid-semester last semester that the chapter PowerPoints were out there, and then I just threw out the full PowerPoints. So the student PowerPoints aren't as substantive. Sorry about that. Yeah.
So that little description at the bottom, is that something
This right here? We won't use them in Cengage, but that's just your typical, in real accounting, we always put like a description under any journal entry to explain what's going on. And that is helpful when we're dealing with notes so we know the length and the interest attached to it. But you don't have to put those descriptions in Cengage. Okay, so the issuance of a note, this was for an accounts payable, so we debit accounts payable and credit the liability notes payable. Remember, as a reminder, liabilities increase on the credit side. So when we increase an account or a liability, we're going to credit it. So notes payable gets credited. Yeah, liabilities increase on the credit side. So when the note matures, just like with the notes receivable, only now we have to pay the interest. Instead of receiving interest, we get to pay it. So the interest calculation is the same. So isn't that nice? You kind of get a review from Chapter 8. Well, hopefully you didn't forget it. You didn't purge all that information. You're going to take your face amount or your principal amount times interest times time in days. Okay, so your interest calculation is the same on notes payable as it was on notes receivable. So we took $1,000 times 12% times 90 divided by 360. The interest due on this note was $30. So here, when we pay a note, we debit notes payable to show it being paid or cleared off. We debit interest expense for the interest that has accrued and that we are paying. And then we credit cash, principal plus interest, or face amount plus interest. Okay. So really on these notes, it's just getting it in your head that we're the ones who owe. But the calculations are the same as a note receivable. Okay. And then it just reminds you, interest expense account is closed at the end of the year. Well, all expense accounts, all revenues, all expenses, dividends, all of those accounts are closed at the end of the year in our closing process. Okay. So here is just a nice kind of summary slide that's showing you from both the borrower and the creditor, different type of note transactions. So Bowden's the borrower and they purchase merchandise on account. We had inventory, accounts payable. This is going back to college accounting, just showing you those original journal entries. And then on May 31st, Bowden issued a 60-day 12% note for the $10,000 that we owed. So we're changing from 2/10 and 30 terms with no interest. When we do accounts payable, this was just an invoice. And now on the 31st, we're switching it to a note. And then on July 30th, we are paying back that note. So these two journal entries are what we just did with a different company and, you know, different numbers. Okay, but it's a good little summary slide, you know, so you can see, and you see both sides. You see the borrower and the creditor. Well, we were the creditor in Chapter 8, but there's those same journal entries, okay? Instead of just borrowing, you know, to extend an accounts payable, we can also just borrow money from a bank, and that's also a note, okay? So assume on September 19th, hey, today's September 19th, isn't it? It's like 9/19/19. So to illustrate, assume that on September 19th, Iceberg Company borrowed cash from First National Bank by issuing a 4,000 90-day 15% note to the bank. Well, when we issue the note, in this case, we're getting cash, so we're debiting cash to increase cash, and we're crediting notes payable. So the issuance of the note, again, is always at the face amount or the principal amount. And then here, this one's one of those fun ones like we did with notes receivable, where this note was written on September, no, this one, sorry. I apologize. Told you it's one of those days, right? I think I had that last week. So this one is due on December 18th. So it's just a 60-day note. So on the due date, December 18th, we debit notes payable for the face value. We debit interest expense, which they calculated again. Principal, 4,000, 15% interest, times 90 over 360. And then we credit cash for the principal plus interest. Okay. So this is the same journal entry that we did when it was on an accounts payable. And it's just the typical note, payment of a note or maturity of a note. So remember, this is the maturity date, December 18th, and that's the maturity value is the cash value we're paying. Okay. So just to kind of recap on the terminology. So that's one way of doing notes. And actually, let's go ahead and go into the practice and do the first practice on that, because we can do that. So make sure you log into Canvas and go to your Chapter 10 practice. Disengage. And we'll do the first one just on notes payable. Do what? Okay. Okay. So this is just a practice on notes payable. So here we have Bennett Enterprises issues a 400,000 90-day 5% note to Spectrum Industries for merchandise inventory. Okay, so we are going to assume a 360-day year. And on Part A, it wants us to do 2 journal entries. And we are Bennett Enterprises in Part A, so we're the ones issuing the note, so we're the ones who owe. Okay, the issuer is the debtor. Okay, so journalize Bennett Enterprises entry to record, number 1, the issuance of the note, and then 2, the payment of the note at maturity. Well, how would I do, this one's just a little different because we didn't debit it this way. What would I credit when I issue a note? Start with that. Notes payable, good, that's my liability account. Well, this one, if you see, it was a note for merchandise inventory. So on this one, we're actually writing a note to purchase inventory, okay? So this one, we're actually going to debit inventory and credit notes payable. Okay, for just the face value or the principal amount of 400,000. And then again, we're going to calculate interest just like we normally would, 400,000 times 5%. And this is a 90-day note, so 90 over 360. Okay.
5,000.
Very good. $5,000 in interest. right, so $5,000 in interest. Okay. 400,000 times 5% times the 90 over 360. Okay, so it's always the principal amount times the interest rate times days over 360. So this one doesn't have us calculating the date, the maturity date, but it would be the same again as you did in notes receivable. So you would look at your months. They didn't even tell us the day we issued it, but we would, do 90 days to get the maturity date. So when we pay this note at maturity, what do I need to debit and credit? Very good. We debit notes payable for how much? The face value. Very good. 400,000. It's not interest revenue because we owe. Interest expense. Good. Yeah, interest expense gets debited, and we calculated 5,000. $5,000 of interest expense gets debited. And then what do I credit? The total. Good. Cash. Perfect. So I add it together, and I credit that amount, 405,000, to cash. Okay. So that's from Bennett Enterprises. We're the issuer or the debtor in this case. We owe the money. Okay. Part B is kind of a review from Chapter 8. We want to journalize Spectrum Industries' entry to record the receipt of the note and the receipt of the payment. Okay. So this one's a little bit different. So now we're on the other end. We're the one the note was issued to. So the note is due to us. Okay, so we're the ones getting money. So on part 1 there, we had sold inventory on a note. So what would I debit and credit to reflect that? Notes receivable. Good.
And sales.
Perfect. And sales. So notes receivable gets debited and sales gets credited for the principal amount. Okay. So it's just kind of helpful to see both sides of it. And then when we pay them, so Spectrum Industries is now receiving payment, what would they debit and credit to receive the payment?
Notes receivable, interest receivable, cash.
Okay. What gets debited?
That would be the notes receivable.
Cash. Yeah, you got it. Yeah. Cash gets debited, right? Because they're the ones receiving the money. The note is getting paid to them. Okay. So cash gets debited for the full amount, the 405,000. Yeah, you credit notes receivable because they now paid it off to us. We're clearing that out. Interest revenue. Interest revenue gets credited the $5,000 of interest. Okay. So interest revenue gets credited $5,000 because we paid them $5,000 in interest. So that's revenue for them. So that's just looking at both sides of it, the issuer and the one that's receiving the payor. Any questions on that one? Okay, good. Okay, so I'm going to hit next and go to the next one, but we're not quite ready. I'm just going to let it load. I'm going to go back in here. Okay, so that was just a typical notes payable. Another concept we deal with notes payable is a discounted note could be issued. Okay, so instead of it being interest bearing, we discount it. So really, we're still receiving the money. It's just that we kind of take it up front. It's just a little bit different. Okay, so in this case, a discounted note has the following characteristics. The interest rate on the note is now called the discount rate, okay? The interest on the note is now called the discount rate. The amount of interest on the note, called the discount, is computed by multiplying the discount rate times the face amount of the note. The debtor, or the borrower, receives the face amount of the note less the discount. So instead of giving them $1,000, we're going to give them $1,000 minus that interest. So basically, when we have a discounted note, it's like we're collecting the interest up front. Okay, so they don't have to pay the interest when they pay it back. You know, we're taking the interest off of the face value from the very beginning. So instead of giving them $1,000, we may give them $900 or whatever it is. Okay, so we're going to take it off the top. Okay, so the proceeds of the note is the face value minus the interest or the discount. Okay, and then the debtor repays the face amount. So we're still earning the interest, you know, we're just taking it again up front. So it's just a little tricky. We're going to recognize the interest expense when we issue the note. Okay, so we're taking the interest at the issuance date. So it's just a little different. And some people prefer that as opposed to accumulating interest. And then from our standpoint, you know, if we're the one that the note is being issued, or if we're issuing the note, we're paying the interest up front. From the one that's on the other end, the person that's loaning the money, they're getting their interest up front. So it's a little bit better of a situation for them. And that works really good at the end of the year, because then you don't have to worry about an adjusting entry for interest. So it might be a good idea to issue discounted notes when you know that note's going to be paid in the next fiscal year, because then you've already recognized the interest expense. So that's one benefit of doing a discounted note. Okay. So let's look at it. So again, it's just a little different, but it's the same calculations. You're just looking at it a little differently. So on August 10th, Carey Company issues a $20,000 90-day discounted note to Western National Bank. The discount rate is 15%, and the amount of the discount is $750. Well, as you can say, we're saying discount instead of interest, but your formula is the same. The face value times the discount rate times 90 divided by 360. Okay, so your calculation is the exact same. You don't have to calculate anything differently. The difference is we're recognizing that interest up front. So we're taking the face value, the $20,000, minus that discount amount. So we're actually going to give them $19,250 and go ahead and recognize the $750 in interest. And then when this note matures in 90 days, they're going to pay us the full $20,000. So your proceeds are the same. You know, I mean, if this was, the only difference would have been that we would have issued this, you know, the debit would have been cash 20,000, notes payable 20,000. And then when they paid us, they would have paid us $20,750. Okay. If you look at it all, I like to say it all comes out in the wash, right? It all evens out. It's just we're taking the interest up front. Okay. So we call it a discount rate instead of an interest rate. Your calculation is the same. But we're only giving them, the discount amount. So we're taking face value minus that discount. Any questions on that? It's just a little different. So then when they pay it, it's a simple entry. You debit notes payable for the face value, and you credit cash. We're paying that note off. Okay, so really we're just kind of flip-flopping the ease of our journal entries, right? You know, instead of issuing at face value and then paying off plus interest, we're issuing at a discount, and then we're paying the face value. So it's just a little different. But let's go back into the practice. We'll look at one. We'll do one together. So that way you can kind of see how it works. Okay. So this one's a discounted notes payable. So business issued a 60-day note for $75,000 to a creditor on account. The note was discounted at 7%. So it says journalize the entry to record the issuance of the note. Okay. Well, again, in this case, my calculation, my formula to calculate now the discount amount is the same as calculating interest. Okay? So you're going to take your 75,000 times 7% times 60 over 360. Okay, so again, your calculation's the same.
875.
Very good, $875. We're going to call this our discount amount. Okay, so instead of calling it interest, it's just the discount. So the principal or face value is still $75,000, but the amount that we're giving them, or in this case, giving them an account, it's on account, but the amount that we're going to debit, we're going to take the $75,000 minus $875. Okay, so the proceeds of this note, $74,125. So the proceeds, or the amount that they're getting, is the face value minus the discount. Okay. So this one was on account. So what would I debit if it's a note on an account? Accounts payable, good. Accounts payable gets debited, and we debit it for the proceed value. So the face value minus the discount. If we were giving them cash, or we were getting cash, we would debit cash here, right? It's just which account, what are we settling? We're settling an accounts payable, we're not getting cash. Okay. What else do I debit? Interest expense, good. So I'm going to debit interest expense for the $875, that discount amount. And then what do I credit? Notes payable, good. Notes payable gets credited always. When you issue a note, notes payable always gets credited at the face value of the note, okay? Whether we're issuing at a discount or a regular note, okay? So again, we've recognized the interest expense up front. So now when we pay them back at maturity, 60 days have passed, how much do we owe them? $75,000, good. When we pay a discounted note, we pay the face value because we've already recognized the interest expense, okay? We've paid it up front, yep. So we're going to debit notes payable and credit cash for just the face value. We still consider it an issuance of a note and then paying it at maturity. It's just when it's a discounted note, we recognize the interest up front. So this is issuing a discounted note. Any other questions on that one? Okay. Do what? No, they're not getting any less money. They're actually, you know, they're not having to wait to receive their interest payment, basically. So yeah, they're still getting the same amount of funds from this transaction. They're just recognizing the interest up front. So on the creditor side, they would be able to record the interest revenue right away because they earned it and received it. Okay. Let's see. I kind of talked about this already, the current portion of long debt. We'll talk about that more when we look at installment notes on Tuesday. But, you know, again, an installment note is just when we're making equal payments on the note. So it's a little different. Instead of owing the whole amount at one day, An installment note is when we make equal payments. So we pay $300 a month for a car payment every month for 5 years. Okay. So again, I kind of mentioned that what's owed in the current year would be considered current liability, and what's owed in the future years, year 2 and beyond, is a long-term liability. Okay. But we're going to deal with that more on Tuesday. We're going to switch gears just a little bit and talk about payroll liabilities. Actually,